Hello, everybody. Welcome to Sense of Security Podcast. I'm Mary MacNamara at Interactive Brokers. And today we're going to talk long versus short and short interest. And I welcome Russell Burns with Finimize. He's going to be our guest today and answer these questions for us. So good to see you, Russell. How are you?
I'm very well. Thanks for having me on.
Oh, good. Okay. So first question right off the bat. Let's remind everybody what going long or short means in investing.
Yeah, sure. So going long means buying a stock, expecting its price to go up so you can ideally sell it later for a profit. Going short means selling a stock that you actually don't own by borrowing it, expecting the price to drop so you can buy it back later at a lower price, also making a profit.
Great. So it's win-win. It just depends on what side you're playing, right? A little bit.
Exactly. If you get it right, both sides, you're a genius. It's not easy to do always, but that's the idea.
So for someone new to the markets, how would you explain short interest?
Yeah, short interest is the number or the percentage of outstanding shares of a stock that have been sold short at a particular point in time. So if there's 1 million shares outstanding of a company, 100,000 shares are shorted, that would be a short interest of 10%. So you can normally think about it as the higher the short interest percent, the more negative investors are on the share price outlook.
Is there a normal level of short interest for a stock generally, or does it depend on the company itself?
Yeah, there's no normal number that fits all stocks all the time. And the answer will typically depend on the company, its sector, balance sheet strength, current news, and the state of the overall market. For the biggest companies in the US right now, like Nvidia, Microsoft, short interest percent's currently under 1%. Tesla's sits at 2%, and Intel's a bit higher at 3%. And the short interest percent may be higher for smaller companies for a couple of reasons. One, it takes a smaller dollar amount to impact the overall number. And two, and probably more importantly, smaller companies have generally been less popular for a few years now. So examples of high short interest names are like Carvana and Rivian, which have 9% and 12% short interest percent. And if a company's got a double-digit percent short interest, that means there's quite a lot of investors are bearish on its outlook.
So why would a stock have a high short interest, even if the company's not really doing terribly or badly?
Yeah, there could be a few reasons for that. The company could be doing really well, but the stock price may have run up too far too quickly and valuations look really expensive. Or two, it could be because traders expect future problems for the company or the sector, which could be caused by macro factors, geopolitical changes, or new competition coming in. Or perhaps the speculation that the company may be about to issue new equity to finance further investment or expansion. And investors would want to be short ahead of that announcement to take advantage of the likely drop in the share price. But it's also worth being aware that just because a company's got a high short interest, it's not always negative. Because let's say if a company's issued a convertible bond, some of that short interest would probably relate to hedging out the long exposure from the convertible bond. So the short interest could be high, but it's more technical in nature, not just because traders or portfolio managers are overly bearish on the company's outlook.
Oh, that's so interesting. What are some red flags here in the financials that might justify a high short interest, like debt levels, declining revenue, or shrinking margins? You may have just covered this a little bit, but can you add to that?
Sure, yeah, all of those above can be red flags. If companies got high debt levels, you need to look a bit closer to see when the loans have to be paid back. Whether the debt's at a fixed or a floating rate. Can the company cover the debt payments from cash flow, and for how long? And if revenues or profit margins have gone down or expected to fall in the future, that may also justify a lower valuation and a higher short interest, especially if it's caused by something structural rather than just a short-term event. And another important red flag to look out for is if there's signs of aggressive accounting methods that may make cash flow or profits look artificially higher. That can come from actions like channel stuffing, where companies ship excessive inventory to distributors, but the actual products aren't selling. Or it could be where profits are growing, but companies have weak or deteriorating cash flow. And that could come from companies trying to spread expenses over a number of years, temporarily boosting profits, making performance look stronger than it actually is.
Do short sellers tend to focus on specific areas or ratios like cash flow, earnings, quality, or inventory buildup?
They'd look at ratios for sure. Using financial ratios will be a great way to screen for ideas. It could be like high valuations on basic metrics like price to earnings ratios. And they'd look at those on, it could be on an absolute basis or relative to a company's history or the sector. See, some short sellers would look to invest using a sector neutral approach, like trying to go short an expensive company in the sector and long a cheaper one. That's where you try and find real alpha. And for sure, deteriorating earnings could be a red flag. Missing profit forecasts for a couple of quarters would get alarm bells ringing that maybe there's problems under the surface that are worth looking closer at. So there's a variety of potential fundamental indicators that can be used, but often financials and fundamental valuations are not enough on their own. So traders and portfolio managers may wait and look for technical indicators to be more favorable before going short. For example, price momentum turning down, as stocks can continue to trade at expensive valuations for much longer than expected.
I bet it's very popular during earnings season, right? This is where you see traders looking at this at short interest, or in the sense of what's going on in the world right now globally with tariffs, right?
For sure. Around earnings season, there's always a lot of expectation. People would look at the options market to see what price moves are expected, 5, 10%, one way or another for the high volatility names. And then obviously if a company's got a very high short interest and too many traders are expecting the earnings to be weak and miss, just because the earnings are weak doesn't mean the share price will necessarily fall if the traders that are short want to cover. So the stock can squeeze higher on the back of it. So it's not always just what the earnings are. It's like the outlook as well. And positioning ahead of the event is always important as well. So for tariffs, there was been a lot of short activity, at least in the near term, with companies that are expected to be impacted negatively by tariffs. A lot of shorts went out there. But it's get very noisy because headlines can change the outlook. So for copper mining related stocks, Trump announced copper tariffs and then reversed them. And these stocks were all moving up and down 20% as people or traders try to anticipate the move, position ahead of it and everything else. So headlines, especially macro and geopolitical ones, can make shorting much more challenging.
So today, or I think it's today, right? The FOMC is meeting, right, to discuss rates. Is there going to be a rate cut? Does that play into it too? It sounds like all these things could play into it.
Surprises, earnings are obviously a big one because it's stock specific. So what we're talking here is short interest on specific companies rather than the overall market. So yes, for sure, if the S&P 500 falls 3%, all the constituents are probably going to go down too. So yes, for sure. But the FOMC would be more macro related. People may not want to be short housing names because lower interest rates of the FOMC cuts, or the Jackson Hole is this week. It's announced that, the outlook for rates is lower than expected. That's expected to help sensitive sectors. People may not, or investors may not want to be short the housing sector. But if they think that Powell's not going to agree and he's going to say there's going to be no rate cuts for the next couple of months, it's not what market's expecting. But if they're going against that, they may want to be short interest rate sectors or stocks because we're not going to get interest rate cuts. So there's macro factors, can be as big as tariffs, or it can literally be anything and everything, as you said. Yeah, there's a variety of factors that impact the market, sectors, and single companies.
Okay. What about, we have this whole meme craze, right? Are they getting squeezed right now, the short sellers who are in that type of scenario?
Very much, yes. So short interest levels are released twice a month by the New York Stock Exchange, NASDAQ. So it's quite easy to monitor what the short interest percent is for companies. And that makes high short interest names vulnerable to being squeezed out by investors if they choose to do. It's not easy to squeeze shorts in Microsoft or Nvidia because they're much, much too big. But in small and mid-sized names, high short interest names are vulnerable to getting squeezed, as Reddit forums and retail investors have a lot of power now in the markets. So that happened a few weeks ago. And in COVID, retail investors really took over the market and squeezed out some high short interest names and actually managed to put a couple of hedge funds out of business.
Wow. Okay, good. Thank you for joining us, Russell. As always, Listeners, you can learn more about an array of financial topics for free at interactivebrokers.com/campus. And please follow us on your favorite podcast network and feel free to leave us a rating or review. Thank you so much. And once again, thank you, Russell.
Thanks for having me.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Trading on margin is only for sophisticated investors with high risk tolerance. You may lose more than your initial investment. For additional information regarding margin loan rates, see ibkr.com/interest. Short selling is an advanced trading strategy involving potentially unlimited risks and must be done in a margin account.